Welcome everyone to the Global Market Outlook July 2022. The global market continues to sell off. What should you do? So when we sent out the invite to this, we were kind of chatting around the global fears around markets and interest rates and inflation. And everyone I think is feeling very, very nervous in financial markets at the moment. But the good news, and what I put in the email outlook, is that equity markets price in future events. And that means that equity markets are likely to turn long before you see positive economic headlines. When everything looks okay, that's not a good time generally to be buying equities. When everything looks pretty shaky, that generally is the time that you get big discounts. I suppose the real question is, when is the recovery going to start to happen? And when the recovery does happen, how best to position? So we're going to kind of try and answer those questions throughout the presentation. I'm going to start with an introduction. We'll always look at headlines. We'll then look at equity markets, economic indicators, commodities and currencies, and then we'll go through an overview. I've got some quite interesting ideas at the end that we've been toying with over the last month. Before we get started, why should you listen to us? Who's this guy that's just jabbering away on the internet? Am I someone that's worth listening to? Well, I represent Rand Swiss, who is currently ranked the #1 stockbroker, or #1 securities broker, at least in South Africa. We also claimed the People's Choice Award. The awards are coming up. It's always quite important to us because we're obviously a much smaller firm, and we like to try and take on the big banks who have huge budgets and basically try and kill their bonuses. Because it's just a good thing to do. We are also 2 years running the top tax-free savings account provider, and we've won this award in 2019 as well, and a couple of the awards. So I think our clients like us. We seem to be speaking sense. So hopefully you benefit from this. Hopefully I'm building some credibility with the people that are new. As I said, overall securities broker of the year. We placed ahead of big listed banks in South Africa, and hopefully we can repeat the performance this year. I think there's a lot of pressure on us to do it. We're doing our best to bring new research and ideas and education and all the things that we try and do for you guys. So hopefully, if you are a client, you will go vote at least for us when the awards come around. It is, as I said, very important to us. What do we do as a company? We originally started as a stockbroking firm, did the online, that quickly split into private client broking and online trading. So one is kind of a discount thing. You take care of everything yourself, but we give you very low fees. Private broking, much more high touch, old school securities broking. We try and support you with trade ideas and basically really hold your hands through the market journey. If you need options priced overseas, we're sitting there busy pricing options for you. We basically run around and do whatever you guys like in the private broking section. Managed portfolios, we've got a couple of different managed portfolios. The main flagship portfolio that we run is a global equity portfolio. It's done pretty well. I'll take you through the performance of that at the end of the presentation. Structured products, this is somewhere where I really think there's been a big opportunity over the last couple of years. We've been doing it for about 5 years now. We've done some very, very exciting structures. We've just closed a very nice one. And I've got kind of the building blocks of a new one, which I want to take you through kind of how we think about structures today as well. So if you are interested in kind of medium risk ideas, accessing the credit markets instead of the equity markets, and looking for something that gives you a level of capital protection, this could be something that is pretty interesting for you. So I'll take you through that later in the presentation as well. Well, subs business, obviously a lot of our business is offshore these days. A lot of South Africans want to protect themselves by investing internationally, just getting non-correlated returns to the local market. And also trying not to have all the eggs in one basket. You've already got a property here, you've got a holiday home, your car, your business. Having some international exposure is usually a good thing. So offshore transfers really just links all our account offerings and investment options together. And then, of course, we've got Yaku and Viv and a couple other guys that will look at your wealth management there. They'll do full retirement planning. It's for guys that aren't really managing their own money. Not just for stockbroking clients, but for anyone that's looking to kind of sort out their pension products. If you're retiring, these are the guys that you speak to. And as I said, tax-free savings account is kind of a pro bono product for us. We don't earn any money off it, but it's just such a good product to get some serious tax-free returns. And I think a lot of the tax-free savings accounts that are on offer in South Africa aren't maximizing the tax benefit. A lot of them are linked to interest rate products, which aren't going to give you the kind of growth where you're really going to get the largest tax saving if you have a long-term view. So we have a little managed portfolio there that we put in. It's an ETF-based strategy. Werner runs that for us, and yeah, it's super long term, super easy, and we also do it for free. But the only caveat is that you have to be a client. You have to have some other product with us. You can't just come and get our tax-free savings account and game the system. So that's who we are. That's what we do. So let's start looking at markets and what's been going on. So last month, these are the headlines for last month. We looked at oil, bigger output hikes in the coming months from OPEC, but we discussed how OPEC is essentially manipulating the system and giving bigger quotas to people that can't actually increase their output. Elon Musk came out and said he had a super bad feeling about what was going on. It seemed to pan out this month because it's been a tough month. Interest rates obviously going up. Inflation still a problem. It's all those big concerns. So what happened in June? Last month, we just saw like a little bit of a moderation. We saw a lifting. So about a month ago, we were only fearful of markets as people. At the moment, there's extreme fear out there. Now, what is this fear and greed index that I'm referring to? You can find it on the CNN website. It's a composite index of a whole lot of different measures that measure sentiment in the market. So everything from something like the VIX, which we're going to look at in a bit, the volatility index, to the put-call ratio, to a whole lot of different underlying mechanics, and it just brings a nice composite indicator to give you a gauge of sentiment. As you can see, we've actually lifted off the super extreme fear. It's been as low as 7 in May, but people are still very, very nervous. And as I kind of alluded to in the intro to the presentation, that generally in equity markets is a good time to be buying. Especially if you have a long-term view. No one can tell you where the bottom is. If you were hoping that I was going to be able to suddenly say, well, the S&P 500 is going to bottom at this number, obviously I can't do that, but we can start getting a sense of where the markets are and how to drop in. And I've got some ideas on how to do that. But people are very, very afraid at the moment, and rightly so. We're seeing, with the rising inflation, we're seeing all sorts of problems. We're seeing civil unrest across the globe, especially in emerging markets which have poorer populations. We're seeing it in South Africa. In South Africa, I think, I hope you guys are watching. I don't know if you can watch at the moment, because we have, load shedding. Stage 6 was announced in the last couple of weeks, and it's caused all sorts of problems. I mean, we're very fortunate. We sit in the JSE building, so we can't have the market go down. So we've got huge generators and UPSs, and we're up 24/7. It's never a problem. But obviously for the economy, this is absolutely dire. This whole idea of load shedding is pretty scary. Reading Investec notes earlier in the week from Annabelle Bishop, one of the chief economists at Investec, her view saying, if level 6 is a very short duration, and we managed to see load shedding settling down, it shouldn't have a major impact on our growth forecasts, or at least their growth forecasts for the year. And it shouldn't move the needle on how ratings agencies see us. But if this carries on for a month or 2 months or 3 months, this is going to put significant downward pressure on our GDP number. It's going to increase unemployment. It's going to do all the negative things in an economy. So it's been a big one. It's also one of the reasons that the currency has blown out. We sent all the clients, or most of the clients, hopefully you got it if you're on our lists, a little alert just as that rumor came out. So I've just got a comment on the chat saying, I might have to drop off this webinar because I've got load shedding in 30 minutes. Fortunately, we are going to record the webinar. It is going to be up on YouTube, so you can watch it at your leisure in the small gaps of power that you have, which is just a crazy situation to be in. But yeah, like I said, we've seen the impact on the currency there. We'll have a look at the currency chart, a massive blowout. We sent an emergency note out to clients as the rumors of level 6 came out, because there has been a clear correlation between load shedding and specifically rand dollar weakness. And so we sent that note out. There's been a massive depreciation in the currency, but we'll get to that on the currency segment. Just an incredible statement from Jerome Powell earlier this month as well, which I thought I have to share with you guys. They were in Sintra in Portugal, and all the central bankers of the world were gathering, making announcements and doing things. And Jerome Powell, I think, was answering a question to Bloomberg journalist Francine Lacroix, said, "We now understand better how little we understand about inflation." And she kind of responded saying, "Well, that's not very encouraging at all." And he said, "Well, we couldn't predict what was going to happen here." And that is pretty scary in itself. I wouldn't be surprised if markets actually sold last month on that statement. when you consider Jerome Powell is representing the Federal Reserve, which is the most powerful central bank in the world, whose kind of only job, okay, well, they have a dual mandate of growth and employment as well, but really their primary job is understanding inflation. These guys need to understand inflation. So to just say, oh, well, we didn't really get it, we thought it was transitory. Oops, guys, we're totally wrong. Very, very unsettling. And it's one of the reasons that I think, you know, the mistake the Fed has made, you know, just in keeping interest rates very low, and just not being able to tame this, you know, I think it calls into question the monetary policy around the world. We saw weird other things that I didn't put on the headlines for this week, but Zimbabwe is now selling, as of the 25th of July, they're going to be selling gold coins directly to the public. I mean, almost a return to the gold standard, which is basically central bankers throwing in the towel and saying, we're so irresponsible, we don't know what we're doing. Oil prices have started to fall. Commodity prices are under pressure. We did a commodity webinar with the JSC on the 23rd. Took everyone through kind of our commodity outlook and what commodity, where we think commodity prices are in the cycle. I'm just going to share one slide from that later on as well. But yeah, markets are still selling off. It's still a pretty hairy place to be an investor. It's a scary place to be an investor at the moment. And unfortunately, the problem is that it's those that are brave and those that are able to deploy cash and ride through this kind of volatility that are going to make the money longer term. I think it's a Warren Buffett saying, which is wonderful, which is financial markets are, I can't remember it exactly, but it's financial markets are, you know, a wonderful tool for transferring wealth from the impatient to the patient. So yes, it does require patience in these markets, but you know, every execution that we do for new money at the moment, everyone that we're putting into the market, I just kind of have this this warm feeling of like, oh, we're going to come back in 5 or 10 years, and this is going to look absolutely spectacular, because I do think there are real opportunities at the moment. So let's have a look at how bad it has been in the equity market. So this is a heat map of the month that, so it's about a 1 month performance. It's actually going back today. I put the slide together this morning. Just showing you what's happening in the US market. As you can see, the kind of slide in tech does seem to be starting to slow, especially in the big tech. Microsoft only down 4%, Google only down 3.2%. So that's actually outperforming the market in the big tech space for a change. Where we did see big slides, which has been really the only little green spot in the market recently, is the oil and gas industry. As I said, oil prices are starting to come down, and this is just as fears of recession start to build. Oil markets, yeah, again, there's been strategic petroleum reserve releases in the US, which has, I think helped to increase supply a little bit. I mean, longer term, I've seen research notes out that have said that there's a real possibility that we could see oil at $200 or even $300 a barrel. That's definitely not my base case scenario. I don't think we're going that far. I think with the rising interest rates, we are going to compress growth, if you want to put it that way. I think we're going to stop the economy from overheating, and the recession fears are valid, and I think that's one of the reasons oil is falling. But the oil and gas counters, which I had a long chat to a client this month as well, just saying, oh, why didn't you have oil and gas counters? And he kind of said, well, you might have forgotten, we actually had ExxonMobil and we had Schlumberger as well. When oil, we were buying in when oil was negative and around $30-40 a barrel. And unfortunately, we sold out just before the Ukraine war, which I said we unfortunately definitely didn't predict. But we didn't kind of anticipate. I kind of felt that $80 to $90 a barrel was a good range for oil. That's why we exited those positions. And obviously, with the spike up to 130, oil has done very well. But we are seeing a moderation now. Does that mean it's totally over and that we're not going to see oil at $200-300 a barrel? At the moment, it's certainly not my base case, but it is out there. It's in the market that people are talking about oil that much higher. Anyone that's tried to fill their tank, I think today the petrol price is going up. It's over 2 Rand a litre. Up in Gauteng, we're looking at almost 27 Rand a litre on fuel, depending if you're 93 or 95, depending how you fill. I think most people have moved to 93 now. But oil prices have moderated, but there's no question still wreaking havoc in the economy. The other sector that has been okay over the last year is the healthcare sector. So we've seen some of the healthcare stocks also just creating a little bit of green over there. In oil and gas, energy like really under pressure. Consumer defensive still kind of the slant that you probably want to be taking. The more cyclical consumer stocks are under pressure. So anything that requires the discretionary income is going to be probably not the place you want to be during the sell-off. But if you're positioning for recovery, I don't think it's time to get out of the consumer defensives yet and go overweight consumer cyclical. They are still providing some value. But yeah, it kind of makes sense where we are. People are panicking. They're running to healthcare. They're running to consumer. They call it consumer defensive, but it's essentially the consumer staple sector. Financials are also a place that should do better in high interest rate environments. Unfortunately, they're also linked to growth outlooks. So with the view that we're going to potentially go into a global recession, or many economies are going to go into recession, we're seeing the financials under pressure as well. So it's been a difficult month. Let's not mince our words. If we look internationally, my pick, so anyone that, it's actually our most popular event of the year, which is our January. Every January, we do our global outlook for the year, and we talk about where we think we give ourselves 25 binary questions, and we make all these predictions. I actually had a look at that presentation now, because I think one of my calls was at the beginning of the year, I said, I'm actually bullish on a Chinese recovery. I think we've got a lot of bad news about the regulatory changes, a lot of I suppose, friction from the Trump era around, increased tariff barriers for China. And I said, I think a lot of that can unwind just as a global macro call. And I said at the beginning of the year, what I would be buying is, if I had to take a punt for the year, certainly not saying go put all your money in China. I think it's a very risky jurisdiction. We're still very much in favor of the US as where clients should have the bulk of their cash, just because of the way the US economy works. But I said, hey, a little bit of diversification moving into China is maybe not a bad thing. We hold Alibaba in our managed portfolio. We've taken a lot of flack for holding Alibaba as well. We've held it through the ups. We kind of trimmed a little bit. We held it through, and we kind of maintained the core position into the sell-off. And everyone was like, "Why are you buying this rubbish, Gary?" And it's really the reason that we have it is because it is non-correlated to the rest of the market. China can make its markets go up. If the Chinese Politburo decides that they need higher stock markets, I mean, there's been cases where they've literally just put out propaganda on Chinese media outlets saying all retail investors must go buy stocks. We want the stock market higher, and everyone buys and the stock market goes up. So we have seen a settling in China recently. There's talk about a reduction in the tariff barriers from the Biden administration. We've also seen definitely more, I suppose, tech-friendly policies coming out of the Chinese regulators, which, as you can see, it's literally last month that was the place to hide. If you were in China, you did pretty well last month. It's bucking the trend, and just as we saw, I mean, if you followed these presentations for a long time. As we saw the slide, the US and every market was going up, and we saw this like gradual, almost like a deflating tire in the Chinese markets over the last, say, 2 years post-COVID. That's now starting to reverse, which, I mean, is it just a blip? Is it going to, collapse again? I don't know. I still think that China is a nice diversifying opportunity. I think that a segment of any portfolio should probably have some exposure to China. At the moment, we're holding Alibaba. A lot of people will, naturally South Africans will hold exposure via Prosus and Naspers into the Tencent through their Tencent holding. That is going to change, and I'm going to tell you about that in a second as well. While I was looking at that January presentation, I saw, I forgot we did an internal stock picking competition. So I'll just share some results of that while we're going. Like I said, difficult here. So just to remember this was a local stock picking competition only. We kind of said, hey, if you put all of these stocks together, you might build a nice little portfolio for yourself. So it's been an interesting year. So the overall market is actually down 12%. So I know you can't eat relative performance, but I was very happy to see that. Okay, this includes our administrative staff and our marketing and marketing team, etc. But yeah, it's interesting to see that half our guys are actually positive for the year. I'm happy. I've only got a 3% return, but that's better than a negative 12% return in my 3-stock portfolio. Remember, the reason that we do 3 stocks is that if you look at portfolio management theory and specifically if you can get non-correlated positions, you get about 65% of the benefit of diversification by holding just 3 stocks. Diversification benefits kind of max out, compared to an index at around 30 or 40 stocks in a portfolio. So if you're someone that buys 150 stocks in a portfolio, and they're all part of the S&P 500, chances are you're better off just going and buying the ETF and buying all the stocks. You're not going to have a material outperformance. You're not concentrating your portfolio enough. But yeah, this is kind of where we're sitting. Unfortunately, Pascal is leading the pack with 6% up, which is, I suppose, you always have to listen to your wife, so I'm never going to hear the end of this. But yeah, with that, only 2 people underperforming the overall market. So, and I see Werner's got, he hasn't done well, but he picked Mondi ahead of obviously the invasion of the Ukraine by Russia. But if you chat to Werner on the lines when you speak to him, give him a bit of hassles about his stock picking. But overall, I think that's just something for a little bit of interest. Do you think China will visit Taiwan? Is a question on the line at the moment. I don't think so. I can't remember what we said in January, so we'll have to review that in 2020, the 2022, at least the outlook for 2023 presentation in 6 months' time. I can't remember what we said, but I get the feeling, I mean, they're looking, but I think they must be looking at Russia and what's happened and starting to go, no, this probably isn't the way forward. But I'll chat a little bit more about that in a bit. Okay, next slide. So just looking at, this is just S&P versus volatility. You can see the VIX is still elevated. So this is almost another indication of the fear and greed index. We're sitting at about 27.5 on the VIX, much higher than it was pre-pandemic. It's never really gotten back to that 12, kind of that steady 12 to 15 level that we saw trade for so many years. I've put a little line on there saying that we haven't actually in the last 2-3 months seen a moderation at all. There hasn't been, volatility has remained very, very high. S&P 500, as you can see, is in a down channel. We have kicked off the lows that we saw kind of mid last month. But we're still definitely in that down channel on the S&P 500. So if you are looking for a turn on the market, I would just give it a little bit of space still. I don't think that there's any rush to be going in and buying immediately, but getting the right positioning. Again, you never know when things are going to turn. So to have for me, it's about dollar cost averaging, slowly moving cash into the market. Every month we kind of deploy a little bit more. We still have quite a high cash weighting in the portfolio. But yeah, up at the top there, if we see a break of that upper level, I think that's where, there's kind of a lower level as well. Then I think, maybe start getting involved more aggressively. But for now, mid-channel, definitely market's still weak. I've asked the guys on the desk, so I try to nail them down to some bottom picking predictions for you guys. I haven't got them yet. I'll try them again in the research meeting tomorrow. But Verve still reckons September, October is going to be the bottoms. That's where he reckons. He thinks it's a timing thing. The view on the desk still is that inflation is going to peak. Not inflation is going to peak. Interest rate tightening is probably going to peak first quarter of next year. That's our current estimates. Or at least slow from these very, very aggressive rate hikes. But we'll go through the economics in the next section. Quick update on South African news, because you guys always ask me about it. As I said, I talk about Naspers and Process. So this month, remember, we had the big announcement. So wonderfully, I remember we run a European portfolio. I've got Process in the European portfolio. And I just thought, I hope I've bought for everyone. I went and checked. Everyone that has cash in the European portfolio has been bought into Naspers, which is awesome. Because remember, when we buy into model portfolios, we do time the market. We normally take about 3 to 6 months at maximum to drop cash into the market, depending on where the products are. As you said, we're quite bullish on China, so I kind of had the view, Tencent is, Naspers and Process trade a big discount to the Tencent asset. It has to be in portfolios. There was a lot of debate about it before putting it into that European portfolio, because South African investors that have local exposure generally do have Naspers or Process in their portfolios already. We kind of looked at the ranking. We looked at the investment case behind it. We said we have to have this in portfolios. What happened today, or what happened a couple of weeks ago, Bob van Dijk and the team have come out and they've done what the market has been begging for forever, which I kind of felt like eventually they had to bow to the pressure, which is that they're going to do the financial engineering that we all hoped they would do, which is they're slowly going to sell Tencent out in the market and use those sales to fund a purchase of Naspers and Prosus shares to try and deliberately narrow the discount. As so often happens in financial markets, as you'll find with central bankers, as soon as the intention is known, the market re-rates automatically. So even without having to do it, they got a 25-30% pop on the stock almost overnight on the announcement. So they managed to narrow the discount 30% without even starting to implement the plan. And now who knows how they're going to implement the plan, because the market has already gone, okay, if they're implementing that, the stock is worth a lot more. Fortunately, anyone that was in the European portfolio is now up 40-50% on their Naspers position already. Does this mean that Naspers is now a sell from our point of view? No, I don't think so. I think you've got to keep it in portfolios. Now the discount, the discount to the sum of the parts is still fairly wide. But yes, the idea, and I think this is it. There's a lot of negative commentary, especially from the institutional desks and institutional analysts, about how terrible the management team is at Prosus, and how they basically just they've got this amazing one bet that they've done on Tencent, which has created all this value, and they're not distributing it to shareholders, and they should be shot. And how can they have such high pay packages and all of that? And I think, and they also look at it and say, oh, you're just throwing money into these horrible, tech startup businesses, food delivery that's never going to make money, and OLX, and now they've closed the OLX, which is great. And they said, well, this is all just rubbish. Like, how can you back a team like that? Management teams are very important when you're allocating capital. And there's been huge pushback against it. And I think from our point of view, I mean, I've held Naspers in local portfolios and in offshore portfolios. The view for me is you can change a management team. And if there's that much hatred from the institutional desks, there will be shareholder pressure to change the management team. Or at least change the strategy, which we've now seen coming through. And our view was that discount was so wide that negativity was already priced into the stock, and the margin of safety in the stock was fairly high. And that's why it had to be in portfolios. The view has panned out, and we're very happy with it. If Naspers and Prosus keeps running, we've got China running as well at the moment, which would be helpful for that. We might sell out of the European portfolios. I probably will keep it in South African portfolios. Why would I keep it in South African portfolios? It's very difficult with the spread of instruments on the JSE to get a company like Naspers. It gives you access to, yes, it might be decreasing its weighting in Tencent, which is a fantastic gaming asset. It's done really well. But remember, all the young startup businesses that it's deploying capital into, it only needs one of those to really fly, and they'll create all the value. It's a way that you can get access into the early stage VC tech industry, which you can't do. It's very difficult to get that in listed markets, even internationally. So to be able to do that through the South African market is quite attractive to us. So I would go through it. Okay, I've got Dan, I see your questions. I'm going to do Rand Dollar. I'll definitely chat about BRICS under South Africa as well. CA&S Group, CA and Sales Group is listed on our exchange. So that was quite exciting. It's the second listing that we've had this year. It's they came downstairs, they blew the kudu horn. It was really fun. It's actually the first South African company that's listed this year, because the other listing that we had was Southern Palladium, which was obviously a dual listing on the ASX as well. It's in Australia. It's a non-South African company, can I put it that way? So it's nice to see a new company coming to the exchange. We haven't got coverage of it yet, but just nice to see that our options are increasing in the horrible slide of counters that have been listed in South Africa, and all the delistings that we've seen over the last couple of years. It's fun to actually be able to participate in a listing event again. That kind of prompted me to go have a look at the JSE. Simon on one of the shows asked me to have a look at the JSE. They came out of the trading update this month, just saying that their headline earnings are going to be up between, I think it was 24 and 32%. So I kind of had a look at it, and I mean, when I was chatting on the show with Simon about it, it's the JSE as a share, because you can go and buy shares in our exchange. It's a hold. I mean, there are 3 institutional analysts that cover it, and they all have it on hold. You kind of look at it, I'm telling you, there's not going to be a listing boom anytime soon. I don't think it's going to be that big It's not a growth company. You're not suddenly it's not going to be the next 10 bagger in your portfolio. It's not going to be a Thungela. Let me put it that way. But in the current environment where we've got everything very, very red, having a look at the JSE, it is not expensive and it pays a very high dividend yield. So if JSE is trading around 100 Rand a share, which is where it is at the moment, looking at their earnings, so if they're going to make around 10 Rand earnings, 10 to even 12 Rand earnings. I mean, it depends what the second half looks like. Their kind of halves are very, very varied. It's like if they have a good first half, they have a bad second half, and it always kind of flip-flops backwards and forwards for the last 5 years anyway. But if they manage to have a good second half as well, I mean, there's going to be a decent amount of earnings coming through. They benefit from volatility. The volatility is high at the moment. Most of their revenue actually comes from market data. I'd like it. I think it's an interesting place if you're looking for a defensive counter to just go and park some cash for a little while. They've got a dividend payout policy. It's between kind of almost 60% and 100%. So the idea, if they're making 10 Rand earnings, I mean, you can expect sort of like a 6, 7, 8 Rand dividend coming out of that, and you're going to get 8%. Plus, there's the option that you might see a little bit, if you see markets starting to turn around, you might see a capital appreciation within the business as well. That 100 might go up to 100, 110, 120 again. And so I like it as a defensive stock pick at the moment. I put it out on Business Day as a stock pick as well. The other guys, PPC. We had to chat about PPC a little bit. Okay, so PPC. I don't think PPC is a buy at the moment, but they are doing a lot to try and almost protect their business. I mean, remember, this business has been around for about 130 years, I think. I think it's one of the longest running businesses on the exchange. It's basically trying to just shore up its balance sheet. It paid down about 1.2 billion rands worth of debt. It's got about 1 billion rands worth of debt still on its balance sheet. They did this by selling, basically, I think it was PPC Lime and the Botswana aggregates business. So they're selling off some kind of non-core assets, just trying to improve their balance sheet, bunker down, and get through this. Without a proper construction boom, without real infrastructure spending, I don't see PPC really shooting the lights out. So I'd just be cautious. But it did come out. It is a business trying to get itself right. What else do I have up here? Storage. I like storage for a long time. With the COVID pandemic, with everything that's going on, their occupancy rates have been very, very good. They also get to reset their leases fairly quickly, and they're benefiting from hybrid working as well. A lot of people using their storage business, so we had numbers out of them, looked very, very good. Thungela. Okay, so Thungela, like I'm going to talk about basically coal prices and energy prices now. I do think we're getting towards the top of the cycle, so I think be careful of Thungela. I would tend to be looking to exit Thungela. I know a lot of people have made a lot of money on Thungela. I would just be very, very cautious going forward. They had an update just explaining how Transnet and basically just trying to export their coal has become very, very difficult. Lots of complaining there, but also there's going to be volatility in that underlying coal price. So I think just be careful on Thungela at the moment. Standard Bank also came up with a voluntary trading update before the closed period, basically highlighting all the uncertainties that we've talked about already: higher inflation, slower growth in South Africa, load shedding, fertilizer and fuel prices going up, food prices going up. They think that we're in a tough spot. At the same time, they're a bank. The Tier 1 capital ratio 13.5%, still very well capitalized. Their ROE currently sitting at 14.7, so it's still not doing what FNB it could do, which is what we've got in the local portfolio. But overall, not terrible in a difficult environment. They did obviously have some system issues, and it seems all our banks other than Nedbank are having system issues at the moment. But so that's, I think that I've covered all of those ones. Oh, and Shaftesbury, so last one is Capco and Shaftesbury are merging. So Capital and Counties is going to be taken off the exchange, and you will get a new company called Shaftesbury instead, which is going to be 35% retail, 34% hospitality and leisure, 17% office, 14% residential. Remember, this Capco has always been kind of those Earls Court properties in London, but it's a UK property REIT, which I've always kind of liked, actually. I just think we've kind of steered clear of it in Brexit. We don't hold it in portfolios. But I've always thought that at some point, if we see a real re-rating in property, I mean, Capco can do well, but that's Capco. Obviously, I'm going to go over again. I try to make this presentation shorter, but okay. US economy, what's happening at the moment? Okay, so we're a little bit early this month, so I don't have the non-farm payroll numbers for you. So I've just put up the expectations. They'll be out on Friday. I think it's going to be very difficult for you guys to read the non-farm payrolls this week. So the expectation is that unemployment is going to stay at 3.6%, which is looking more and more like frictional unemployment, the level of unemployment where there's just natural, people change jobs and then they're unemployed because they're looking for work. The expectation is that, like on the non-farm payroll number, last month we had 390,000 new jobs added. They're expecting 268 at the moment. That will fluctuate into the number. But the thing that I think is going to be more important than anything else is looking at the average hourly wages. So they're expecting that to moderate from 5.2% to 5%. I think that's the line everyone's going to be looking at, because it's all about inflation, let's face it. And I don't know, sometimes unemployment numbers, good numbers or bad numbers. When you have high unemployment, it means, oh, the Fed's going to cool it on the rate hikes. And sometimes it means, oh, we have we have high unemployment, so things are bad. People are unemployed, the economy is going to slow. We're not going to have the growth coming through. Earnings are going to collapse because the economy is slowing down. So I think the read at the moment, I think people are more concerned about how aggressive the Fed is being. But I think it's going to be a very difficult number to read. So there hasn't been like a consistency on whether good numbers are good numbers or good numbers are bad numbers on those prints. But it's going to be interesting to see. I think it's going to be that average hourly wage number. I don't see how it's going to come down, but the prediction is that it's going to come down. So that's, I think, what we're going to be looking at quite closely. 28th of the month, we're going to get the first reading of US second quarter GDP. Remember, they're already sitting with a negative quarter. So this 28th could be the announcement that the US is in recession. Inflation numbers are coming out on the 13th. They're expecting, okay, so where we thought inflation had peaked, turned out to be just a blip. When I say we, the whole world, and everyone got a little bit more optimistic, and then we got that horrible print last month. This month, we're expecting it to be pretty bad. So that's why the expectation is already baked into the market. We're thinking 8.7% inflation. That's the consensus number at the moment. So we're thinking inflation in the US, the rate of inflation, the rate that goods and services are, like the price of goods and services are going up, is going to accelerate, which is terrible news if that's true. But I think with the expectation that it's already going to be weaker, maybe there's a bit of room for a positive surprise. If there is a positive surprise, equity markets might kick up. I've given you a long term. So last month, we also had a 75 basis point increase in the Fed. So just so that you understand what that means, it means that our dollar deposit accounts, remember we do FCA accounts through Investec for clients, we can give you just over 1%. It's around 1% on dollars at the moment, just a call account, like a cash account in dollars, which is cool, because if you want to kind of park in dollars, I'm going to look at it under currency in a second. Well, actually two segments on, but yeah, interest rates are rising. It's getting tough out there, guys. It's getting really tough. In South Africa, we had the South African inflation print at 6.5% inflation now. That puts us outside the top of the target band. We've been talking about that for a while, and I've been saying there's no way South African inflation remains moderate when global inflation is where it is. We've kind of had a wind. We've been lucky because we have structural problems with our economy. Interest rates don't contract spending in South Africa the same way as they do internationally. So we haven't kind of seen it, but we will import inflation. There's no question about that. You can't have oil prices above $110 a barrel and not have inflation become a problem in South Africa. You can't have a petrol price of 27 Rand a litre and not have an inflation problem in South Africa. So finally, that's come through in the numbers, 6.5%. The Reserve Bank will be announcing, I'm assuming, another interest rate increase on the 21st of this month. So we've got a couple of weeks to go. So if you are looking, so we've got a lot of clients also looking at the more attractive rates, because also on fixed deposits, we've got a whole fixed deposit suite in Investec. We can give you fixed deposits at the rates are looking pretty good at the moment. I mean, you can go and lock up at 8-9% for a couple of years. and people are saying, well, the market's falling and maybe it's not going to turn and maybe we're going to be in a difficult patch for the next 2 years, 3 years. What can I get on interest? I think, like I said, we think the top of the cycle is going to be first quarter of next year. So we still think interest rates are going to be increasing. You wait 2-3 weeks, then we relook at the fixed deposit suite. You might get an extra 0.5%, even an extra 0.75. I think consensus is sitting that we'll get another 0.5% up on interest rates. Pay down debt if you can. Savers, you are being rewarded at the moment. So yeah, unemployment numbers, we're not going to get unemployment for a while, but unemployment did moderate slightly. GDP also, our GDP numbers, I think are going to, they have to, like if load shedding continues, GDP expectations will start to drop. Okay, so commodity markets, what's happening in commodity markets? There it is. So this is the clock that I put up. So I suppose it's a business cycle clock, if you want to put it that way. They used to call it the commodity clock as well. And it just, you try and work out where you are in the cycle, because commodities are very cyclical. So like kind of looking at cyclical theories is maybe not a bad thing. Everyone that was piling into commodities, like in the webinar last month, I said, the JSE commodities webinar, I think they wanted me to say, yes, buy more Tungela, buy more Anglo-American shares. But I think it's I think we're in the wrong part of the cycle, to be honest. We had that Goldfields deal out. It seems like the miners are starting to do transactions in a silly way. We've got real fears of recession. That's not good for commodity prices. And yeah, this is kind of like the cycle that we're going through at the moment. I mean, we've gone through kind of rising commodity prices already. There's this boom time. Real estate values, not in South Africa, but international real estate values are flying. Real estate values have risen. Interest rates are now starting to rise because we're in the slowdown period now. Falling share prices. We're experiencing falling share prices. We're past 2 o'clock, in my opinion. We're sitting at about 3 o'clock on the commodity clock, which is falling commodity prices, which is what we're starting to see. Then we're going to see tighter monetary policy. We're already seeing tighter monetary policy, but we're not in recession yet. I think we will see the US go into recession. South Africa, I think, will go into recession at some point as well. I do not see how we can avoid it. I'll be very surprised if we avoid it. I think recession is coming. I think that's what's in our future. And that's why I think it's a little bit early maybe to be buying in, but remember, we're trying to time when are we going to really like hit the accelerator on deploying cash. How long, if you want to put in money on a fixed deposit, how long do you fix your money for? I think if you fix it for 2 years, you're already going to be in the recovery phase and rising share prices, and you're going to have missed it. So I think, like we're looking at the next 6 to 18 months, definitely within the next 18 months, like the bottoms will be in my opinion. But yeah, I think even the next 6 months, like I said, Verb reckons third quarter, so like September, October, that's where the real bargains are going to be had. If you listen to Michael Burry, who was out here, he says we're about halfway through the sell-off. Terrifying, absolutely terrifying. If we are only halfway through the sell-off. He says you've seen the share prices re-rate. Now you're going to see the earnings re-rate, which will put more panic on the share prices. And then everyone will panic, and then you'll have the bottoms and the best opportunity to buy stocks ever. You'll buy a few stocks and then you'll retire. Okay, so let's have a look at commodity markets. So this is the Refinitiv Core Commodity Index, and the Bloomberg Commodity Index is in purple. You can see what's happened. So the blue square there is from when we last spoke. So the last time we did this presentation, you can see it's just been carnage in the commodity markets. Commodity prices are falling in a big way. So if we go back to the commodity clock, that's why I'm kind of pegging us at 3 o'clock at the moment. I think we've hit. Have we hit peak commodities? Who knows? Like maybe not. Maybe we're going to grow, and maybe there's just not enough supply to handle everything. But commodity price is definitely under pressure. That's just the composite overall index. If we look at oil markets, we've seen a moderation in oil markets as well. Now there's a lot going on in oil markets, but I think the biggest question, and I'll try and talk about the BRICS here and how it will affect South Africa. So if you look at commodity markets in general, if you look at oil markets at least, what we've seen is Russian supply is being absorbed by India and China. Like there's no question about that. Chinese imports of Russian oil rose 55% in May. Russia is finding an outlet for its supply. And it's selling it to people like India and China who do not care what the US or Europe says to them about sanctions, or that they'll do whatever they feel is right. So then, yeah, so sorry, the call's coming through. So yeah, so that's basically where we're, so one, China and Russia are buying oil. The second thing is that there's many European economies that just cannot survive without Russian energy. They're trying to move away from it aggressively, but they physically can't. So now we've seen the idea of price capping. We've put out an article. If we haven't published it to you yet, you'll get it in the weekly note on Monday. But basically the idea that, you know, capping oil prices, instead of capping volumes, because they can't cap volumes, they, like, Europe can't survive without Russian energy. They're going to try and target transport companies and insurance companies to try and get them to cap the price. So you can do the volume, you just can't pay that much for it. That also, I think, is a very interesting way of doing it. They can do this because they have a control within the financial system. The problem is, you know, even though some European countries need Russian oil, China and India don't care if they're going to buy Russian oil, which is kind of making the sanctions almost irrelevant to an extent. If you look at what's happening with Biden, and you look at what's happening in other Western democracies, and I suppose any democracy, inflation is a real problem. I don't know if you saw the shutdown, national shutdown, South Africa. I mean, people are blockading Kimberley because of rising petrol prices. It's very politically untenable to have high oil prices. So the pressure on easing up sanctions on the likes of Iran and Russia is very, very attractive, even to Western politicians who want to be seen as being very hard on the war in Iran. So oil markets are in a tough spot, and I kind of get the sense that the market's saying, one, growth is contracting, and two, the supply is going to be made available. And that's maybe why you're seeing a little bit of a moderation in oil prices currently. Okay, commenting on the BRICS and its effect on South Africa. So BRICS is obviously Brazil, Russia, India, China, South Africa. So Viv's also put out an article just around BRICS. I think this is where the question is coming from. The whole idea that there could potentially be the BRICS setting up its own almost quasi-separate financial system to the typical Western financial system, things like the SWIFT payments network, and deliberately to try and get India, Russia, China off, you know, to limit the financial control that kind of traditional Western economies have over their ability to make payments. We've already seen, so traditionally all oil and gas is paid for in dollars. We've already seen oil and gas now, oil and coal at least, now being paid for in local currencies in transactions between Russia and China, for example. So things are changing. The world is changing. The world of commodities is changing. But I do think we might have seen peak prices, is what I'm saying. So those are kind of the energy markets at the moment. Softs, also slight moderation in softs. If you look at coffee, sugar, rubber, each has their own individual stories beneath it. So I've got all the codes up there if you're specifically interested in an underlying commodity. But yeah, the blue block again is what's happened over the last month. A little bit of a moderation there, but not massive. I wouldn't expect the food prices to come down dramatically. If you look at the power complex, so just to go back to the power argument, you can see power prices in Europe still a massive problem. Look at the base load in Germany and Austria, that like off the charts this month. I mean, there's an energy crisis in Europe. It's a massive problem. It's going to stoke inflation. It's going to destroy consumer spending. It's, I think, one of the reasons that we're seeing a huge amount of pressure on Euro stocks companies at the moment, which is wonderful because I still have a lot of cash to deploy into that portfolio. I think we're going to get in at amazing levels. As I said, one of the few things that we have in that portfolio is process. Well, I say few things, but it's one of the executions that we have been doing. But yeah, I think tough times for Europe ahead. Encouragingly, so we had Malaysian palm oil was actually limited down this morning on the palm oil future. But if you look at grain seeds and oil seeds, you can see huge drop off this month as well. So soft commodity prices coming down as well. That is a very, very good thing, because that could potentially moderate and temper inflation. I think a lot of the civil unrest that you're seeing at the moment, certainly in developed world companies, is the rising cost of food. It's a massive, massive problem. So to see a moderation, or an early moderation in grain and oil seeds, that's very positive. Will the Fed raise interest rates by 75 basis points or 50 basis? I think it's going to be another 75. That's my view. I think you're in for another 75 basis points. Okay. It's just my view. I think South Africa, I haven't kind of formulated my view what we're going to do this month, whether it's 50 or 75. I do think it's going up though. There's no one thinking it's going to moderate. And I think the Fed has no choice. I think it's going to come down to that inflation print as well. But if inflation accelerates again, they're not going to have a choice. They're going to have to do 75 basis points. And unfortunately, people are now talking about the hard landing versus the soft landing. We put out a little chat about it recently as well. Just remember that the way that you cool an economy as a central bank, what interest rates do when you raise the price of money. So what is an interest rate? The interest rate is the price you pay for capital. That's what an interest rate is. It's the price of money. When you increase the price of money, it becomes more expensive to borrow. So it's more expensive for you to have a bond on your house, but it's also more expensive to fund any project. A business that has to survive has to make higher earnings in order to cover its weighted average cost of capital. So businesses have to be more profitable to survive. Unprofitable businesses go under. So the way that rising interest rates cools an economy is it kills weak businesses, and it just destroys things. It destroys the economy. It's essentially like chemotherapy for an economy. It's like you're damaging the economy to protect the economy longer term, because there's this problem of inflation, which is like a cancer in an economy. It's actually quite a good metaphor, or analogy at least. So the problem is, with the Fed rising, I mean, yes, the markets are pricing this in already, but yeah, it's tough, man. It's going to be tough out there. Let's not mince our words. Okay, so let's look at the currency market. Can you comment on Rand dollar going forward? That is the next slide. Unfortunately, like I said, we're doing this presentation very early, because weirdly the first Friday, we normally do it after the first Friday. This presentation is always the Wednesday after the first Friday of the month. It just happened that the first Friday of this month was the first. So it is quite soon. So I actually don't have the updated poll statistics yet. From all the banks. So these are still last month's polling statistics on the currency. They're just not out yet. The poll hasn't been released. So I can send it around. When we send around the slides for the presentation, hopefully the poll has already been released there. But you can kind of see from last month, these are the same figures as last month. At that stage, the price was 15.32. The price at the moment is around, just before I started the presentation, we were at 16.70. 16.70. So if you watched last month's presentation, you would have heard me saying, I had the target out at between 15 and 15.35. We got to 15.17 as the low, and I'm so happy that you guys listened to me, because Christo did a whack of currency trades. A lot of guys took our cash, and we bought dollars at between that 15 and 15.35. We're now at 16.70. The view on the Rand dollar going forward is a tough one, but I wouldn't be buying dollars at this stage just yet. I think if you look at it, depends on the length of the view that you're looking for. Dollars is a great place. Like I said, you can park at 1% interest rate at the moment. The problem is that inflation in the US is at 8.6%. So if you're getting 1% and the dollar is devaluing at 8.6%, which is kind of the official statistics at the moment, you're losing 7% on your money while you sit in dollars. It's not a great option longer term. But if markets are going to fall and your other option is put money in and lose money, it's maybe not a bad place, but it's a temporary parking spot. Just remember that. It's very much a temporary parking spot. Okay, I'm not saying they can't hear audio. I don't know if that's an individual problem, but please let me know if anyone else can't hear audio. It looks like my levels are bouncing, so audio should be fine. But Yeah, at the moment, this is the most bearish forecast last month was Danske Bank at 17. We're almost at 17 at the moment. So we'll look at where, like I have almost no doubt these banks and brokers will look at what's happening and they will shift the target band a little bit higher. I've put the technicals together as of today. You can see from an RSI, I've just got a 7-day wilder RSI on the bottom here. Above 70 is technically a sell. So I do think that we're a little bit extended in the short term. That said, if you look at this technical, if you look, so that's the wilder down there. If you look at the technical picture here, so it seems like a lot of squiggles, but they're just channels. So we're in that channel. We broke out of that channel into a weakening channel. We went through a strengthening channel. That's broken out. Now we're quite clearly in a weakening channel at the moment. I think we might test 17, which is going to be the top side of the most bearish forecast from the banks last month on a 12-month view. I think you might test that upper trend line. That said, I'll be perfectly honest, both me and Christo have derivative contracts open. We've both sold dollars and bought rand on derivative contracts at the moment because we both think that short term the currency will probably appreciate. I think a lot of this has got to do with the negativity around load shedding, as well as the dollar index, which is the next slide, which I'll show you. But I think, you know, I've done a tranche entry at 1650. I'll do another tranche entry probably at 1690, 1710, 1720. I'll do my third tranche. I normally enter positions in 3 tranches. Then I'll sit and hang on and hope that that things moderate. I think another reason that the rand is blowing out at the moment is because commodity prices are falling. Remember, the currency is the rand dollar specifically, very, very linked to commodity prices. When commodity prices fall, the rand falls. So if we do see falling commodity prices for a lot longer, me and Christo are both going to burn on that trade and have to take a stop loss. Those are just our personal positions. They're PA trades. They're not. We're not doing it's not part of a trading strategy for clients or anything like that. That's just our view. Remember, we have to we are constantly watching rand dollar because so many transactions go through and everyone's looking for levels all the time. So you kind of get the sense, like you get to the point where you're like, oh yeah, I'll take a few contracts there. So at the moment, yeah, so I do think that we're going to moderate. I think like a target of 16. I'd probably, you know, like I said, I'd probably try and take out somewhere at the bottom of this channel, but it could take you a month, 2-3 months before you get there. And there's no indication. I mean, I had a client asking me today, it was a client we've taken a lot of dollars out for a couple of years ago. And she was asking us, when do I think it's going to hit 20? And I was like, well, there's no brokers or big banks that think it's going to hit 20 in the next 12 months. I mean, the rand weakens on average about 6% a year against the dollar, but I don't know. Depends what the South African Reserve Bank does, I suppose. If we get a 75 basis point hike or 0.75% hike, it might firm up the currency. If you see load shedding suspended for the next couple of months, you know, rand can firm up very, very quickly. There has been some positive developments in South African politics as well. So I don't think personally, like I said, I always tell people, like, I mean, as much as I want you guys to invest in offshore portfolios, and anyone who's invested in them was kind of smiling because they looking at this dollar and going, in rand terms, I'm super rich. But yeah, I don't think now is the time to go and hit the trigger. I think this is the time that you prepare your trade and you wait for a little bit of weakness. That said, like, we are kind of experiencing a breakout at the moment, so it's about 10 cents weaker than this at the moment. Yeah, so that's rand dollar. Now what is going on there? So like I said, part of it is the rand portion of the trade. The other half, the other side of it is obviously the dollar component as well. So this is the dollar index, which is an index of the dollar against the 6 largest trading partners. You can see what's happened over the last, say, 2 years. It's just been a rush into safe havens, and as the Fed increases interest rates, people can suddenly get a yield on their dollar deposits. People are just flying into dollars like it's like it ain't no thing. It's still a reserve currency of the world, and it is still a real parking spot. So if you're a momentum trader, I mean, buying dollars is probably not a bad idea. You know, if you are looking for a safe haven for the next, say, 3-4 months, you know, sitting in dollars, I don't know, maybe is better than sitting in rand. I mean, currencies are very, very difficult to predict. But like I said, my call at the moment is that post load shedding, I think, again, I kind of try and trade contra to the market sentiment. So everything is against the rand at the moment. low to everything is against the rand. We just need a little bit of good news, and we'll hook around. Is my view. But you can see, that's not to say that we can't. I mean, the direction of the trade is very, very clear longer term. So, if you're sitting everything in rand, you should have probably been listening to us the last couple of years when we've been saying take funds out of the country. Dollar index, so that's just giving you a sense that the dollar is strengthening against everything. It's not just against the South African rand. The dollar is strengthening against the euro. It's strengthening against everything. So just on that, just looking a little bit more investigation of the dollar. So on the left, we've got the euro dollar, which I also found is called the fiber, and I think that's just because the pound dollar is called the cable. But so I think they wanted to be cool and call it the fiber as well. But yeah, basically euro dollar. Euro dollar is almost at parity. So the last time we had euro dollar at parity, and when I say parity, $1 is going to be the same as €1. The last time that happened was not 2022, it was in 2002. So a lot, 20 years ago since we saw the dollar and the euro trading at the same levels. That is imminent. That is coming. A little bit more dollar strength against the euro, and you'll have that. But you can see that kind of trend there is what's happened. That's just dollar just decimating the euro, and it makes sense. I mean, the Eurozone has almost got a war going on right next door, and it's really, really tough. The energy prices, they are going, their consumers are being killed. I think life in Europe is going to get very, very tough. We do an immigration webinar as well. Maybe Europe's not the place to go to. Okay, then I just did the cable, which is basically the pound dollar. You can see the global financial crisis is the last time the dollar had the big strengthening. So you can see the dollar strengthens when times are tough. When everyone is panicking, they buy dollars. That's what they do. That's what happened to pound dollar. They sold pounds and bought dollars in the financial crisis. Around Brexit as well, that was kind of just the Brexit period as well. But we're also seeing a strengthening of the euro against the dollar, and that's kind of the global macro outlook at the moment as people rush to safety. What's happening on the pound rand? Okay, pound rand, I think we're kind of mid-channel at the moment. Again, I just drew the channels in for you. So nice, weak, strengthening channel, weakening channel of the, depends what you're looking at. Weakening rand, strengthening rand. Now we've kind of broken out, and it looks like we're starting to set up another weakening channel here. So I think longer term, we are going to look at a weaker currency locally, especially if commodity prices fall. I just think maybe a little bit of strength in the next. I think by next month, we'll get you better levels. That's all I'm saying, but definitely prep your trades. Yeah, so top of the channel kind of will be 20, call it 2060 would be top of the channel. I'd definitely be buying rand. I'd be converting pounds to rand in that situation. 1950, I would say, like a little moderation. Between 1950 and 1980 is probably not a bad place to go out. I'd probably rather be buying pounds against rand at the moment than dollars, but that's, again, it's just because that dollar has been so rampant. Next one, Eurozone. So very similar picture setup. Remember, like 2 months ago, we flagged this little breakout. We said there's the kind of weakening channel. I said it's starting to accelerate downwards, but it was kind of a bit of a weird acceleration. I said it's too steep. It's not a viable channel. We're starting to see that weakening channel setting up there around weakening channel again. We had that breakout there, which we said, listen, it's hovering at the top here. We don't know if it's going to drop back into the bottom of that channel, but just because of that break, just watch out. And it has continued to weaken as well. So rand is also weakening against euro. Like I said, last month, I said 15 to 15.35 was taken out. I'm not going to adjust that. I'm going to say, let's sit tight. I mean, I know we're 16.70 at the moment. I would be buying rands or dollars. I'm sorry. Like I wish I could say otherwise, but I wouldn't. I'd look for moderation. 15 to 15.35. Let's give it a couple of weeks and see what happens. Would be my best call at the moment. But when it appreciates, if you're back in the 15s, I would say definitely take out. Maybe don't wait for the 15.35, but let's also see what happens with commodity prices. If you want to be kept abreast of everything that is happening at Rand Swiss, please do check out our research offering. We have a weekly wrap, which is free for everyone. So even if you're not a client, you're welcome to go sign up to that on the website. For our online trading clients, Christo puts out a lot of technical ideas, local stocks, currencies, all sorts of little recommendations. And for selected private clients, we have Anthony Clark's small cap research for guys that are interested in local. We can also share some of the big sell side institutional research like JP Morgan, Goldman Sachs, UBS, etc. But that's only with selected private clients. So if you're interested, please go sign up. Thank you, everyone. Stay safe. Enjoy the rest of the week.